a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
And today we are talking about gold ETFs. So we hear a lot about digital gold, Bitcoin prices surging, but actual gold, physical gold prices have also been hitting record highs lately. They are now up more than 10% year to date, and particularly during the month of March, they did quite well. So here are the reasons why gold prices have been rising. First is rising hopes for Fed rate cuts, hopes that Federal Reserve will start cutting rates soon. And in fact, CME Fed Fund futures currently suggest more than 50% chance of a rate cut in June. Now, lower interest rates make gold more attractive because gold does not yield any income. With lower rates, the opportunity cost of owning gold goes down, and it makes those lower rates make gold attractive relative to income-paying assets like stocks and bonds. Then central banks around the world have been buying gold for their reserves in order to diversify away from the US dollar mainly. And the central bank buying increased after the 2008 financial crisis, and then particularly after Russia's invasion of Ukraine, central banks have stepped up their purchases. Last year, central banks around the world purchased more than 1,037 tons of gold, according to the World Gold Council. And these include central banks of China, India, Turkey in particular. China in particular has been buying a lot of gold in order to reduce its dependence on the dollar. And last year, their central bank, the People's Bank of China, they purchased more than 225 metric tons of gold, which was their highest gold purchases ever. Now, gold is seen as a safe haven asset in times of volatility and geopolitical risks. And geopolitical risks have been rising, particularly due to Russia-Ukraine war and Israel-Hamas conflict also shows no signs of slowing down. There are rising tensions between China and Taiwan as well. So during these times of uncertainty, investors tend to increase their exposure to gold. And then China and India, these are the two largest consumers of gold in the world, and their consumers have been buying a lot of gold. And we know that China's economy has been slowing down. The real estate market is in crisis, and stock market returns have been very weak. The investors have suffered losses in real estate in Chinese stocks. So they have been increasing their exposure to gold in China. In India also, investors have been buying gold in order to protect against inflation, and their incomes have been rising in India because of economy doing quite well. So Indian consumers have also been buying a lot of gold. So if you expect inflation to stay sticky at elevated levels above the 2% target that the Federal Reserve has, then maybe some exposure to gold makes sense. And I believe that gold deserves a small place in the portfolio mainly because of its diversification benefits. It has low correlations with other asset classes. Now let's take a look at some popular gold ETFs. So the first one that I'm highlighting is the largest and most liquid gold ETF. It tracks the price of 1 by 1/10 of an ounce of gold has 59 billion in assets. This is not cheap. 40 basis points expense ratio, but it is very popular with traders. So if you want to invest, do short-term trades, then GLD makes sense. Now you can go to the quote page on Zacks.com, read our research report articles. You can also go to State Street webpage, read their research for gold in terms of holdings. There's nothing to see. This is a physically backed gold ETF. So they actually hold gold bars in a vault, and totally risk-free, very convenient way of owning gold. Now, then State Street also launched a mini version of GLD, which charges just 10 basis points and tracks the price of 1/50th of an ounce of gold. This has also become quite popular with almost 7 billion in assets. You will get the same exposure, so I'm not going to State Street's webpage for this ETF. So this makes sense if you are a longer term holder of gold. So if you want to invest in the long term, for the long term, look at the cheaper version. Then another ETF that I like is the mini micro version of IAU, iShares Gold ETF. This is the cheapest gold ETF with an expense ratio of just 9 basis points. Though 9 and 10 basis points, not a lot of difference. So either GLDM or IAUM is fine for long-term investing. Now, if you are bullish on gold, then maybe you can take a look at a gold miners ETF. The one which is most popular is by VanEck. The ticker symbol is GDX. So gold miners are like leverage plays on the metal. So it provides leverage exposure to gold prices. This is also quite popular with 13.5 billion in assets and charges 51 basis points. If you want to learn about this ETF, you can go to the quote page on Zacks.com, and from there you can go to VanEck's webpage for this ETF, and it holds popular gold miners like Franco-Nevada, Wheaton, Goldfields, etc. Now, on the next slide, I have the comparative price performance over the past month here. So over the past month, the gold miners ETF surged 16%, and gold prices surged about 7%, whereas the S&P 500 index was up about 2%. And this is the comparative price performance over the past year. So over the past year, gold had underperformed stocks significantly, mainly because of high interest rates. So gold was up about 11%, and GDX, the gold miner ETF, was almost flat. Now, even though gold prices have gone up a lot over the past month, they're still much below their earlier record highs, particularly in inflation-adjusted terms. Thanks for watching. Make sure to check out Zacks.com/promo for an interesting offer. And also make sure to subscribe to our YouTube video channel so that you do not miss anything. And I'll see you next week.